Hello, everyone, and welcome to what I think is the first of today's Treasury Lab sessions. My name's Kathrine Meloni. I'm a special advisor in the debt finance team at Slaughter and May, and I'm here with Matthew Tobin, who's a partner and head of our debt capital markets practice, and Tom Vickers, who's a partner in our restructuring and insolvency practice. Now, the word unprecedented has been overused, significantly overused in 2020, but it's an accurate description of the levels of emergency financing activity we saw during the first half of this year. And in this session, we're going to look at how the second half of the year is unfolding in the debt markets. We'll have a look at the sorts of finance that are available, and we'll talk about the terms on which that financing is available. And also some of the themes that are starting to emerge as corporates review and refinance arrangements put in place in the March to June period. Now, we had hoped that today's title would be International Finance as we emerge from COVID, but seeing as we seem to be moving into another phase of all of the pubs being shut early, we've had to adjust that to international finance in the second phase of COVID. As I think many of you will have heard in the earlier session run by Lloyd's, it looks like it's going to be a reasonably long haul to recovery. So against that backdrop, we'll also touch on the stakeholder dynamics we've observed in some of the more recent restructurings that have come out of the COVID period, and also the UK government's regulatory response, which includes some really quite material reforms to the UK's insolvency regime, and how the government is supporting those that find themselves in that territory. A few housekeeping points, which I suspect you'll be quite familiar with by day 4. Firstly, there's a toolbar at the bottom of your screen, which you can use to submit questions. So please do that, and we'll do our best to answer as many as possible. Secondly, a reminder that this session is being recorded and will be available shortly after the session finishes on the ACT's event platform. And finally, the ACT is very keen that you engage with the conference sessions on social media. So please use its LinkedIn groups, its Twitter handle, and tweet using the annual conference hashtag ACTAC20. So let's get started. Turning to you first, perhaps Matthew. As the summer drew to a close, we started to see a number of companies reevaluate their financing arrangements, their shorter-term arrangements, and think a bit more about longer-term planning. And the top priority for many companies has been liquidity and their main bank facilities. And I think that reevaluation process is now starting to turn into transactions, so new financings, refinancings, and amendment deals. I wondered if you might talk us through what we're seeing in the loan market, and in particular the reactions we're seeing from the banking sector as new deals start to move forward.
Yes. Hello, everyone. I guess before I answer Kathrine's question, I guess there's a sort of question as to whether the second phase is going to look similar to the first phase in terms of COVID. And I know that for some companies, they will be looking again at the waivers that were obtained in the context of the first phase and seeing whether they cover a potential second phase. Clearly, most of the waivers obtained in the early part of this year were time limited. So there is the question in relation to covenant waivers and waivers of cessation of business type covenants. Are they satisfactory in relation to a potential second phase? And I know that's an issue for companies in particular sectors. I guess moving to your question, Kathrine, in terms of actually what are companies doing that were looking to refinance in the second half of this year? The paradigm for a long time now has been the 5+1+1 deal, and there is a question as to whether actually anybody's obtaining that at the moment. And in terms of new deals, I think we are seeing a sort of pushback to 3+1 or in some cases 4+1, but a move away from the 5+1+1 that companies have generally seen. We have seen a number of companies postpone a refinancing if they can, and add another year, where, because they don't want to engage at the current time with their banks, and on taking a judgment that next year might be an easier time to refinance than this year. And I think that's something which obviously none of us know what's going to happen for the rest of this year, but clearly if the situation gets worse again, then that's a possibility. In terms of what we're seeing from banks, we're seeing that some banks have been tightening lending criteria, and there has been a retreat among some banks, both on a sectoral basis, and also some evidence of a retreat on a geographic basis away from particular geographies. And that's something that obviously anyone who's thinking about refinancing will be bearing in mind at the moment. To some extent, this is all very familiar territory, of course, and banks are typically pretty cautious in post-recovery periods. And at the moment, with the lack of visibility as to whether the crisis is really over, we're seeing that caution multiplied. Relationships, as ever, are key in this type of environment, and staying close to banks and being sure where support is going to come from. And I would say that I think banks have been pretty supportive in terms of what we saw in the first phase of the crisis. The question is really, in the longer term, where are the banks going to be? And we've seen indications in syndicates that there will be one or two banks departing. So, as I said before, some banks postponing a full refinancing, some banks looking at some borrowers looking at extension options, using accordions, using incremental facilities. And that, I suppose there is a benefit to doing a sort of soft refinancing at that stage in terms of testing relationships if the next refinancing is going to come next year. In terms of technologies that we've seen used, there's the hollow tranche idea, which we first saw developed after the financial crisis, of putting another tranche in a loan to which banks may move that want to extend. That's technology that's coming back. We've even seen, again, old technology but being used in this time, a revival of the forward start structure, which involves extending the maturity of an existing facility by entering into a parallel loan on improved terms, which will incentivize lenders to remain in the deal. Clearly, the advantage of any of those routes is that the thought that lenders are more likely to drop out of a new deal than an amendment to an existing deal, and I think that's driving quite a lot of behaviour at the moment. One more technical point, which people will be very aware of, is that from now on, when borrowers are amending or refinancing loans, and if those loans reference LIBOR, which of course most loans do, replacement rates will need to be addressed. So borrowers are going to need to think about how and when they're going to switch from LIBOR and factor that into discussions.
Thanks, Matthew. So I guess for those that are thinking about approaching the market, the short point is that there are a lot of different options to explore at the moment, and it's quite important to weigh those up carefully. I guess the other important consideration is whether loan finance is the answer at all, or whether it's worth exploring other options. And again, I know that debt diversification has been a theme that's been touched on already in a number of sessions in the last few days.
Yes, again, I mean, it feels like we're moving back to the post-financial crisis period, doesn't it, in terms of diversifying away from bank finance. I guess one of the things that we absolutely saw in the first phase of this was that where borrowers had investment grade bonds in place, they generally didn't have to worry about the bonds, because bonds are, generally speaking, covenant free. There are some sectors where that isn't the case, but in most sectors, investment grade bonds don't have covenants. So we didn't see a lot of people going out for consent solicitations in relation to their bonds simply because they didn't need to. In terms of diversifying away, we've also seen a rise in convertible bond issuance. That tends to increase generally in periods of dislocation or disruption in the debt markets. And we've seen that a little bit too. And we've seen also a move of ESG investors into the convertible bond space, which is interesting. I know we're going to touch on that later. What are the other products we've been seeing? US private placements. We've seen a lot of our clients look to access the US private placement market, and clearly they offer something a little bit different in terms of flexibility on issue size and currencies and maturities. So that's something that clients are generally looking at. Obviously, that is a product that originated in the US. Typically, we see them being governed by English law for UK clients, and typically adapted to the terms of the bank deal. So financial covenants generally following the bank deal. So in terms of ease of negotiation, typically quite easy to negotiate. Downside, and we did see this a little bit during the phase one of the COVID amendments, is that they can be difficult to negotiate and can be asking for slightly different things from the banks, even when you're starting off with the same covenants. But clearly a good option in the current market. We've also seen other direct lending products have come to the fore, particularly, I'd say, for companies in the crossover or leverage bracket. And as has been widely reported, some credit funds have significant amounts of capital to deploy, and there's some scope at the moment for those funds to compete with banks in terms of pricing.
Yeah, I think the broadening reach of direct lending funds is an interesting development, and I agree it's something we've seen before in dislocated markets. Some of the audience might have read about the $1 billion that Bombardier borrowed from HPS in the North American market, and I think that capacity does seem to be coming to Europe with the asset managers that have teamed up with sovereign wealth funds to increase their firepower this year. So it sounds like a real option for larger as well as the medium-sized corporates. So there's a menu of financing options, strategic planning to navigate your way through all of those options well in advance is what's needed. Matthew, I just wanted to come back to one point. You touched on ESG in the context of convertibles, but is this a feature that companies are thinking about as they come back to refinance and amend in the loan and bond markets?
Yeah, absolutely. I think it's really interesting, actually, in a year where everything has changed. The focus on ESG hasn't particularly changed, in the sense that we're seeing just much more focus on ESG. And I think some people have wondered whether that would move away as a result of the crisis. I mean, if I was to say something, I'd say actually it's the reverse. There's been more interest in ESG finance as a result of the crisis. I think the other interesting thing is some signs of pricing tension being introduced as a result of introducing an ESG aspect to a refinancing, because there is more money behind ESG investors perhaps than has been the case before. So I think in the case of the convertible market, whereas that market for a long time has been dominated by hedge funds, actually ESG finance moving in there and competing with hedge funds to push down the pricing, which is a really interesting development. We were involved in Burberry's sustainable bond. That was the first sustainable bond in that sector, and I think it's an example of ESG finance moving into different sectors that hasn't been previously perhaps seen as candidates for green or climate change bonds. I suppose the other thing just to mention is the development of transition bonds. Cadent Gas issued a transition bond earlier in the year. Those are for issuers that have businesses which are not green businesses, but are making efforts to transition to a more sustainable business model. It's interesting in terms of, that's a pretty nascent market, and what we're seeing in this market is development all the time, and to some extent regulatory catch up too, and also market catch up. So, for example, because the London Stock Exchange's sustainable bond market doesn't have a segment for transition bonds, the Cadent Gas bonds were admitted to trading on the main market. So yeah, absolutely a space we're seeing loads of activity and loads of development.
So there's lots happening in the E of the ESG, in the green environmental loan and bond market. But what about the S and the G, sustainability and governance? Has anything been happening more recently in that space?
Yeah, I guess that's perhaps something where you'd say, well, up until this year, it's been more about the E, less about the S and the G. Actually, perhaps as a result of the COVID crisis, we've seen more focus on the S and the G than we've seen before. I think that S and the G part is more difficult to define. And of course, one of the issues more generally in this market has been the difficulty in defining in any given sector what constitutes the S and G. So I think there have been moves, I mean, particularly in terms of the taxonomy regulation by the Commission, which is actually a really ambitious piece of legislation to try and make definitions around this area. I mean, similarly, targets like those in the UN's Sustainable Development Goals do offer a helpful regime in terms of what is a sustainable. So I think, I mean, in answer to your question, yes, E is still very important, but more of the S and the G.
Thanks. So it seems, in the debt markets generally, we're dusting off techniques that we last used post 2007, but ESG is the area where we're really seeing some innovation at the moment. Yeah. We've talked about the different products available in the debt market, but an aspect of this year's financing activity we haven't talked about yet are the government support schemes, which of course been available in the UK, but also in many other countries around the world. And the government has responded to the slightly subdued or the subdued outlook for the autumn by announcing in September a number of changes to its debt financing support schemes. So the C-bills, the Coronavirus Business Interruption Scheme, the CL bills, the same scheme for larger businesses, and then the Bounce Back Scheme and the Future Fund Scheme. And these have all been extended or amended in different ways, although the government has decided not to extend further the flagship scheme for larger companies, the Coronavirus Corporate Financing Facility. So the end date for that remains the 22nd of March next year. Matthew, I know you've been advising a number of companies on their government financing options. Do you want to say a few words about how the government schemes have been used by mid and larger size corporates in particular, and perhaps a little bit about the impact of the changes announced more recently?
Yeah, so to take the last part of that question first, the measures announced in September were reasonably limited in terms of their impact on mid-sized to larger corporates. The key point about that announcement is that for companies looking at the CL Bills scheme, there's a little bit more time to get deals done, and the deadline for applications for CL Bills and also for smaller companies for C-Bills and the Bounce Back Scheme and the Future Fund, that's been extended to 30th of November 2020. And I know that that was welcome news for a number of our clients looking to access those schemes. In terms of what we've seen, the first part of your question, so what we've seen more generally, the CCFF scheme has been very widely used by larger companies, or actually, in terms of number of applications, very widely used. In terms of actual companies drawing down under the CCF, a little bit more limited. Just as an indication in terms of what we've done, we've helped around 60 companies access the CCFF and the CL Bills scheme. And I think, I mean, just by way of observation, I think the CCFF process was generally a little bit easier for larger companies to navigate. I think the CL Bills scheme obviously grew out of the C-Bills scheme, which was designed for smaller companies, and I think there were a number of issues in terms which clients faced in terms of accessing CL Bills, just around how the sort of starting point for that scheme. I think CL Bills, obviously, there was also the issue that banks needed to be comfortable that the product they were offering sat within the strict terms of the guarantee that was being provided by the British Business Bank, and that gave rise to some issues. But clearly, that scheme has been helpful in terms of providing access to government finance. In terms of the decision not to extend the CCFF, I mean, I think there's a view out there that larger companies are not where the particular issue is. And going back to what I was saying earlier, that the debt capital markets have clearly been open through most of the period of the crisis, and indeed pricing has been very positive for investment grade companies that have been able to access those markets. So I think the government have sort of narrowed their attention to where the need is greatest, and the perception that that's not at the level of larger companies. I think clearly the introduction of restraints on executive pay and dividends caused some companies that had applied to the CCFF and indeed had drawn down money under the CCFF to think twice about actually whether they wanted to be part of that scheme, and in some cases their money was repaid. So it's become less attractive for larger companies. So I think in terms of exiting the CCFF or exiting CL Bills, that's a reasonably straightforward thing to do, as you'd expect. The government doesn't want to be as long-term lender to companies, and a number have done that, as I just said. I suppose the last question is, what are we going to see in the future? There is more to come. So the Chancellor confirmed last month that the government's developing a new guaranteed loan scheme that will launch in January 2021. So we will look to that. I guess in terms of what we would expect to see, we'd expect to see more targeted support to sectors that particularly need that. And as I said, that's partly smaller companies. Equally, there are clearly some sectors of the economy that need the support more than others do.
Thanks. So I guess the key takeaway for those that are thinking about government support is to act quickly if you want to access the schemes that remain open, because the window will close next month, and keep an eye out for the next round of announcements from the government. Yeah. So On that note, perhaps we can shift gears a little bit now and look at what we're seeing in the restructuring arena. We've touched on the many COVID period or initial COVID period covenant relaxations that we saw earlier in the year, and many of those amendments that we saw being put in place in the first half of the year were relatively short term, as you'd expect, and many of them run off into Q1 and Q2 next year. So as the path to recovery seems to continue to lengthen, that does suggest, as you said, Matthew, that we will see another round of balance sheet support measures in the form of liquidity facilities and more covenant relaxation requests, perhaps on a slightly adjusted basis to accommodate the new circumstances. But for some companies, more significant amendments to their capital structure might be needed. So, Tom, can I turn to you now to talk a bit about what you're seeing in the restructuring market at the moment, and whether you can give the businesses listening some pointers on the issues that they should be aware of?
Sure, thanks, Kathrine, and hello, everyone. When I sort of say nowadays I'm a restructuring lawyer, people say, oh my word, you must be extremely busy. And the answer is I have been busy, but not in the way I think people expect. I think people perhaps at the beginning of this crisis assumed or expected that there would be a wave of restructurings across, not perhaps every sector, but a huge range of sectors. And we haven't quite seen that. What we've seen is a variety of industries that were already in some level of difficulty before the crisis began, and the crisis has exacerbated those issues. So where we have seen activity is in the oil and gas arena, where oil and gas prices are often a sort of leading indicator of economic activity, and COVID and OPEC together in sort of the early part of this year has really depressed oil prices and has forced and is forcing some restructurings to happen in that area. And then, of course, retail, which has been in some difficulty, particularly high street retail, has been in some difficulty for a period of time, as well as other sort of areas of activity where sort of customer interaction is key. So retail, but also dining, leisure, travel, all those sectors have been damaged, and we've seen it, genuinely a wave of restructurings in the retail and restaurant and leisure sectors, as one might have expected, but not necessarily more broadly than that for the time being. And the reason for that is because of the level of support that's been available that Matthew has talked to. There's been generally supportive banks. Banks have not wanted to, given the option, have not wanted to, trigger enforcements or accelerate loans. They would rather give a waiver and see how matters develop in due course, rather than crystallize the problem at the worst possible time. We've seen the government support, which is maintained very high levels of employment and consumer spending, as well as the funding that's gone directly into corporates. And you've seen equity markets sort of step up in across a range of industries to shore up balance sheets that have been badly damaged. I mean, one of the surprising things from our perspective as a firm is that we thought that our corporate teams might be quite quiet through this, and actually, although they've stopped doing as much M&A as they might have done, they've done a lot more work in the equity raising arena. So far, it's not been quite as bad as expected, but I wouldn't want to give people any false hope. What we are starting to see is now some troubling suggestions that things are starting to get worse, and businesses that have so far survived are starting to get into more difficulty, and that's sort of borne out by discussions we have with other advisors in the restructuring arena, in the banks and the advisory firms. And there's sort of two or three aspects to this. One is that some businesses have been able to get by deferring sort of meeting liabilities, and therefore managing liquidity to sort of get through. But some of those liabilities haven't been discharged. So the classic example is a retailer who hasn't paid their rent for several quarters. That rent, although the government prevents the landlords doing anything about it for the time being, that rent is still due. and will come payable. And that's just a sort of a simple example of what is a broader problem, that balance sheets are getting laden with liabilities without the corresponding profits necessarily to meet them. And then more concerning is the developing sense that there is a growing level of liquidity issues within some businesses that perhaps have assumed or planned for the recovery that Kathrine mentioned at the beginning of the session, that we all hoped we would be in by now. That not having happened, and us now going into potentially the second wave or the end of the first phase, or however you characterize it, means that perhaps some business plan assumptions about when activity will resume are not holding good, and therefore, cash inflows have not been sort of as expected, and therefore some businesses are being brought to the table, the restructuring table, because they have an urgent need for cash, and that from our perspective is really troubling, because the sort of the key to doing a restructuring successfully that preserves value and provides the best outcome for the creditors, but also the company and equity, is to go into that with a range of options. So the more options a company has, the better placed it is to ensure it sort of gets to a decent outcome. However, for many businesses, developing options is complicated because of the complexity of their capital structures, and therefore what you can do is constrained by what your stakeholders allow you to do. And therefore, if you're in a restructuring where you need new money, liquidity to come in to enable the business to continue operating, but you have a secured structure with complex creditor consents needed to bring new money in, and creditors who are not necessarily, whilst they might be supportive of giving a waiver, they may not be supportive of new money going in ahead of them, you have potentially some real issues in solving, in the near term, a liquidity issue. So if you are expecting to have that kind of problem, the sort of the takeaway, I suppose, is start planning at the earliest possible point, because some of these deals can take months to develop, agree, and then implement. You can't sort of turn on a dime and do them overnight. So if you're in a sort of position where there is concern over liquidity, it is better to sort of, as a precautionary measure, start thinking about what your options might be if you needed to solve for that, and start doing that sooner rather than later, because otherwise you may find control is taken from you by your lenders, and solutions are imposed on you rather than ones that the company leads. So that for me is the sort of the concerning look forward that we might be facing.
So it's interesting, isn't it? We haven't seen the acceleration in full-blown restructurings yet that we might have expected, but the pipeline certainly seems pretty full. So many businesses will be busy thinking through what to do. In terms of restructuring processes and options, there's been a lot of discussion about the new measures introduced by the UK's Corporate Insolvency and Governance Act earlier this year. Tom, I wonder if you could run through what those new tools are for those that aren't familiar, and perhaps also give us your thoughts on whether you think that, with these new tools, we have all of the tools in the UK that we need, or I would ideally like to rescue companies that are struggling.
Sure. I mean, that is in fairness a big question, and if I had an hour left to speak rather than 10 minutes, I could easily fill the time. In a nutshell, I think the UK has always been seen as a good restructuring destination. So we've always had a set of tools and a set of restructuring practitioners who have been reasonably pragmatic in using what's available to sort of rescue businesses. And that's been great for people like me, because we've been able to use the London market as a market in which we've been able to restructure European companies, and companies from further afield have come to use our procedures. And in many respects, what we have is in some respects world class. So techniques like the scheme of arrangement, is one of the great procedures available to help a company restructure some of its debt where it can't quite get to the level of consent needed under the documents, say 90% or 100%, but it can use a scheme to impose a deal with a 75% creditor vote. And the UK has been, excellent in in being a venue for restructuring. But there's been a growing acknowledgement over the last 4 or 5 years that what we have isn't quite good enough. That it started with a sort of government consultation maybe sort of 5 years ago in the pre-Brexit world, where the government looked at our toolkit and thought, well, benchmarked against some other jurisdictions, we're perhaps lacking some of the tools that might be available or useful. And typically people in that respect look to Chapter 11 in the United States as the sort of quintessential restructuring procedure, and have wondered, well, shouldn't we bring in some of those tools? That led to a period of consultation where the government talked about 3 or 4 measures and consulted on them, and then once Brexit happened, it all got forgotten, basically. That all reanimated, however, when COVID emerged and the government realised that although Brexit is important, they also need to sort of think about whether we've got the right tools for restructuring companies. And I think the key area where what we have got as a set of tools before COVID was lacking was in dealing with companies that are trying to restructure a balance sheet problem, but also have a liquidity crisis or an operational crisis. Because as I mentioned, fixing a balance sheet, we can do that, but you might need quite a long runway to do that. You might need 6, 9, 12 months to do that. And if you're running out of cash, you run out of time. And that's the sort of scenario that a Carillion or a Thomas Cook found itself in, that the ability to execute a restructuring was constrained by the fact that cash had run out. What we've brought in the new Act is therefore 3 sort of permanent new measures which are intended to help solve that problem. I'll come on to whether they do that or not in a minute, but in outline, the 3 permanent measures are firstly the introduction of a moratorium to give companies that are in trouble, that need a restructuring, a breathing space where they get some protection from creditor action. We've brought in what's called a restructuring plan. So it's a variation on the existing scheme of arrangement, but it's more powerful in that it can be used to, do what is called cross-class cram down. So it allows, for instance, a group of secured lenders to vote on a deal, and for that deal to be imposed potentially in some circumstances on junior lenders. And that's definitely a sort of read across from what's available in the States. And finally, there's been the introduction of restrictions on counterparties terminating contracts because a business is in a restructuring. And that's often a huge concern in a distress scenario, that your customers and suppliers may choose to exercise termination rights in their contracts and walk away, leaving the underlying business very vulnerable and exposed. And so we've got some more protections around that, which is really helpful. The question is this good enough? Is this going to help, substantively? I think yes and no is the answer. The restructuring plan is a genuinely really exciting tool, and I think that is going to be used a lot. We've already seen some use of it in the context of Virgin Atlantic, that their sort of restructuring was implemented by way of a restructuring plan, and Pizza Express is going through a restructuring and refi at the moment, using a restructuring plan to ensure that the deal gets approved, and there'll be a wave of others, because it gives a huge level of flexibility. By way of example, the Virgin Atlantic restructuring plan, it didn't just deal with consents from your normal range of financial creditors. It also sought to compromise trade creditors who are normally left outside of a restructuring. This restructuring plan enables you to go into parts of the balance sheet that you normally would leave alone on a restructuring and extract some value from there too. So that's going to be, as it develops and as we get some law around it, going to be enormously important. What's more disappointing, I think, though, are 2 things. The first is the moratorium is, on the face of it, really exciting. It gives us an ability to shelter a company and protect them while they do a restructuring. But the government decided that the thing that it should exclude from the moratorium are our company's financial creditors. So you can go into your moratorium and get protection from your trade creditors, but your banks and bondholders are not at all constrained by the moratorium. So, the need to go and get waivers and agree stable platform agreements has not gone away. The other thing that is disappointing and is perhaps lacking is something that's not in the legislation at all, and that's the ability to raise emergency financing on a priority basis. So there was a lot of lobbying to push for what's called a debtor in possession financing procedure, which allows a company to borrow sort of secured priority money ahead of existing lenders to solve the liquidity problem that I mentioned earlier. That has not gone in, and there's a sort of big macro debate about whether it should go in or not, given the impact it may have on lending origination and the approach of your typical secured creditors to the risk of being primed. But whatever the rights or wrongs of that debate, not having it now is going to make restructuring for some companies much harder, because their ability to get money in on a priority basis is going to be very constrained if they're on a short runway. So there we have it. Some good and some less good in terms of the procedures. It all calls, I think, for what I mentioned earlier, which is option planning at the earliest possible stage, and to make sure that you don't find yourself running out of time and money.
Absolutely, I guess, and another important point, which sort of brings us back to really where we were at the beginning, and Matthew talking about the different amendment and refinancing options, is that any kind of a crisis or slide or problem brings the relationships that you have with your stakeholders very sharply into focus, and so managing relationships with your key lenders is going to be very important, and the key to perhaps successfully navigating the options at the early stages. So we're almost at the end of the session. I think we've just about got time for one or two questions. One question, Tom, I wonder if I can come back to you, because it just continues on from what you've just been talking about. Obviously, that we have these new insolvency tools, we have this new Insolvency Act. But for those that aren't headed into a process at the moment, is there any immediate impact for treasurers coming out of that act? Does it have any effect on the the financing terms, for example, that people are signing up to today?
I don't think so, and I don't think it should. And that's certainly the experience that we're seeing. The new procedures may call some bank lenders and bank lender lawyers to think about whether their events of default are framed correctly and whether they've got the right triggers. But ultimately, this is not a sort of set of changes that is going to interfere with bank rights fundamentally, and we're not seeing, for the time being, loan documentation being rewritten to address the problems here. I think, in fact, where more thinking will need to be done will be on the trade credit side, where trade creditors who might previously not have been exposed to a restructuring are going to think about, well, do they have the right information rights? Do they have the right early triggers to bring them to the table at an earlier point in parallel with the banks? If they don't, they risk being the last to find out about the restructuring, which may not be the best place to be.
Yeah, sure. Thank you. Well, I think that I can see the clock ticking down, so we're pretty much at the end of our time. Obviously, if there are other questions, then please do send them through. Join the networking chat room, and we can follow up on those. Thank you so much for joining us. A few reminders before we close. There is a survey on this session in the Q&A box, so please take the time to complete that if you can. Should anyone be interested in a second round, then this session has been recorded and will be available shortly. The ACT has asked us to remind you to please pay a visit to the exhibition hall if you haven't done that yet, and that there are obviously a number of other live streamed sessions today, so please do join those if you can. So I think all that's left for me to say is thank you very much to Matthew and Tom, and hope everybody enjoys the rest of the conference.